Hey friends, welcome to Money RX for CRNAs and nurse practitioners. I'm Brett Fellows, and I'm really glad that you are here today. I want to tell you about a couple named David and Karen. David is a CRNA and Karen is a nurse practitioner. Now they have worked for nearly 30 years combined, and they have saved 1.4 million in their respective 403b and 401k retirement accounts. So they did everything the traditional advice told them to do. They have maxed out their retirement contributions and they have lived below their means. So they should have felt great about retirement. But David and Karen had a problem that they did not see coming. When their required minimum distributions, RMDs, kicked in at age 73, combined with their Social Security income, they jumped from the 12% tax bracket into the 24% bracket. So they're now paying over $38,000 a year in federal taxes. Taxes that could have been significantly reduced or maybe even cut in half. Today, I'm going to walk you through how to avoid David and Karen's expensive mistake. We're going to talk about tax strategies that work specifically for nurse practitioners and CRNAs. And by the end of this episode, you will have a clear plan to potentially save tens of thousands in retirement taxes. Now, most APRNs face a unique tax problem in retirement. You spend 20 or 30 years maxing out your own 403b or 401k contributions. And you also have high Social Security benefits because you earned good money your whole entire career. When you hit age 73, required minimum distributions start, and then you add that income to Social Security, and boom, you all of a sudden are in a higher tax bracket in retirement than you were when you were working. Now, let me give you some real numbers. Let's say a nurse practitioner couple both earned $130,000 to $150,000 a year. They have 1.6 million combined in their 403b and 401k accounts. By age 73, their required minimum distributions alone are about $60,000 a year. Add their Social Security of maybe, let's say, $4,500 a month combined, and they have jumped from the 12% tax bracket to the 22% or even 24% bracket. I call this the retirement tax bomb. You followed all the traditional advice, defer taxes now and pay later. Well, later is eventually here, and it is very expensive. So what do you do about it? Well, the strategy is called tax bracket filling. Instead of paying low taxes early in retirement and high taxes later, you instead smooth things out. You strategically fill up the lower tax brackets during your early retirement years. So you think about your retirement money in three buckets. Bucket one is your tax deferred money. That's your 403b, your 401k, or your traditional IRA. Every dollar that you pull out of that bucket is taxed as ordinary income. Bucket two is your tax-free money. That's your Roth IRA, Roth 403b, or Roth 401k. Withdrawals from this bucket come out tax-free. Bucket three is your taxable brokerage account. This is the account most APRNs don't use enough, and it might be the most flexible tool that you have in retirement. So now let me tell you about Mark and Susan. Mark is a CRNA and Susan is a clinical nurse specialist. They retire at age 61. They had 1.6 million in their 403b and 401k accounts, and they had $350,000 in a taxable brokerage account. From age 61 to 67, they lived primarily off of their taxable account. So they took advantage of the 0% capital gains rate. They also converted $55,000 every year from their traditional accounts to Roth. Now, the result? They saved over $130,000 in lifetime taxes. That is real money, my friends. Money that stays in their family instead of going to the IRS. Now, if you heard it, let me explain how this 0% capital gains rate works. If you are married filing jointly, you can realize up to about $94,000 in capital gains and pay zero federal tax. Zero. This is perfect for early retirement years when you don't have other income coming in. In our example, Mark and Susan needed about $75,000 a year to live. So they sold some investments from their taxable account. About half of that money was their original investment, and the other half was gains on their investment. Well, they paid zero federal income tax on those gains. Think about that. $75,000 of income, zero taxes on the gains. But if you heard, they didn't stop there. They also did Roth conversions. They converted $55,000 every year from their traditional 403B to their Roth IRA. Now, this kept them in the 12% tax bracket, but they were paying taxes on purpose. And they were paying them at a low rate instead of waiting and paying them at a much higher rate later. Now, once Mark and Susan turned 67 and they started taking Social Security, they reduced their Roth conversions to about $30,000 a year from $55,000. They were still filling up that 12% tax bracket, but they had to be more careful because Social Security income can push you into higher brackets. Now let's talk about something that most APRNs overlook: asset location. Not asset allocation, asset location. This is about where you put your investments, not what investments you choose. In your tax-deferred accounts, your 403B or 401k, put your bonds and your REIT holdings because these generate income that gets taxed at regular income rates anyways. In your taxable accounts, put your growth stocks and index funds because these are tax efficient. They don't generate much income until you sell them. And in your Roth accounts, put your highest growth potential investments because these will never be taxed again. This simple strategy alone can save you thousands of dollars in what we call tax drag. Tax drag is when your investments are less efficient because of taxes. Now, if you're doing larger Roth conversions, you also need to watch out for something called IRMA. That's the Medicare surcharge. If your income goes above certain thresholds, you pay higher Medicare premiums. For 2026, that's about $109,000 for single and $218,000 for married couples filing jointly. The key is timing your conversions strategically. You don't want to save $6,000 in income taxes only to trigger $4,000 in extra Medicare premiums. So let me give you a framework about retirement. Think about retirement in 3 phases. Phase 1, these are your early retirement years, let's say before age 65. You primarily live off of your taxable accounts and you take advantage of that 0% capital gains rate. This is when you start Roth conversions and you delay Social Security if you can. Phase 2 is ages 65 to 73. Now you're most likely getting Social Security. You can continue doing smaller Roth conversions, but you need to watch those Medicare income thresholds. You're ultimately preparing for Phase 3. Phase 3 is age 73 and beyond. Required minimum distributions begin. So now you are in spend down mode of your accounts. You use your Roth accounts for your discretionary spending, and you focus on legacy planning for your family. Now let me walk you through The four biggest mistakes I see APRNs make. Number one is what I call the autopilot approach. You max out your 403b or 401k for 25 years plus and never think about the tax consequences. Again, you're building a tax time bomb without realizing it. Number two is ignoring asset location. You put tax inefficient investments in your taxable accounts if you have them. That costs you money every single year. Number three is more all or nothing thinking. You're either avoiding all taxes or you don't care about taxes at all. The smart approach is strategic tax planning. You want to pay the right amount at the right time. Number four is not planning for required minimum distributions, RMDs. You let your traditional pre-tax accounts grow too big and you miss conversion opportunities during your lower income years. Let me give you one more example of how powerful this can be. A nurse practitioner named Angela. She's single, age 63, and just retired. She has $750,000 in her 403b account and $250,000 in a taxable account. She is worried about taxes in retirement. She can live off of her taxable account from age 63 to 67. She can do $35,000 a year in Roth conversions every year, and she stays in the 12% tax bracket. She delays Social Security until 67, and when she turns 67, she starts Social Security, and she reduces her Roth conversions, but continues the strategy. By the time she reaches 73 and required minimum distributions start, she has converted $140,000 to Roth. Now her traditional pre-tax account balance is smaller. Therefore, her required minimum distributions are smaller. So she stays in lower tax brackets throughout retirement. So what should you do right now? First, you want to calculate your tax diversification. Just look at how much do you have in each of the three buckets: tax deferred, tax free, and taxable. If you're like most APRNs, 80% or more is in tax deferred accounts. That is a problem. Second, you want to model different withdrawal strategies. There's software out there like Bolden that can help you with this. Or your financial advisor, of course, should be able to help you think through this and model it out. Third, evaluate your Roth conversion opportunities. Can you fill up a lower tax bracket? Do you have gap years between retirement and Social Security? Because those years are golden for Roth conversions. Fourth, consider getting professional help. A financial advisor who understands tax planning can often save you more money than they cost, especially if you have a complex tax situation. Let me go back to Mark and Susan for a minute. They didn't do this alone. They worked with someone who helped them. Someone who helped them look and model different scenarios. So they looked at what would happen if they converted different amounts of money to Roth. They looked at planning for different market conditions. And by doing this, they made sure that their strategy made sense for their specific situation. The numbers matter to you. Before their strategy, they would have paid about $385,000 in lifetime taxes. After their strategy, they're on track to pay about $260,000. That's a $125,000 difference. Plus, they have better legacy planning for their children. Now, I want to be very clear about something. The goal is not to pay zero taxes. The goal is to pay the right amount of taxes at the right time. Sometimes it makes sense to pay taxes today to avoid paying higher taxes tomorrow. You also need to think about your state income taxes. Everything I've talked about in this video is federal taxes. Your state might have different rules. Some states don't tax retirement income. Some states tax everything. This obviously affects your strategy. Remember, you have 3 tax buckets: tax deferred, tax free, and taxable. The key is using them strategically. You ultimately want to diversify your taxes just like you diversify your investments. Take advantage of the 0% capital gain rates when you can. Consider Roth conversions during your gap years. Think about asset location. Plan for your required minimum distributions, RMDs, and watch out for Medicare surcharges. And most importantly, don't do this alone. Get help, use software, work with a professional. Trust me, your future self will thank you. Don't make David and Karen's mistake. Don't let your tax-deferred accounts grow too big. Do not ignore the power of taxable accounts. And don't wait until it's too late to start planning. You have spent your entire career taking care of everyone else, your patients, your families, your communities. So you deserve a retirement that doesn't come with unexpected financial surprises. If this episode raised questions about your own situation, do not wait. The decisions you make now about retirement accounts, Roth conversions, and withdrawal strategies can have a huge impact on your taxes later. If interested, you can schedule a complimentary discovery meeting with me through the link in the show notes. Thanks for listening to this episode of Money RX for CRNAs and nurse practitioners. I'm Brett Fellows, and until next time, take care of yourself and take care of your money.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.